It's Welcome to the Resolution.
Hi, Jay. We're here today thinking about offering compromise as our next topic for our podcast. Offering compromise has been around for a while. Maybe could we start with what it is, just
Sure.
in the history of it? How long has it been something that someone who might have a liability as a settlement, how long has it been around as an option?
There's two historical trends. One is its actual history, and the other is offer compromise as a marketing phenomenon. All right. But as an actual thing, Joe Louis, the boxer, 1930s, fell behind in taxes. The income tax was invented during Woodrow Wilson's term in the 1910s, and most Western countries brought in the income tax around that time. And Joe Louis fell behind in income taxes because, boxers got paid rarely, and government was, he was such a national icon that the government created a program so he could make a deal on what he owed.
Really?
Yeah.
I had no idea that's where that came from.
Yeah. That is, kind of maybe a wise tale, but I think there is some substance to that. And then in the 1970s, the IRS officially made it a program.
Okay.
And then in the 1986 IRS reform, probably the biggest tax reform that ever happened in the United States the last 25 years, they gave it even more concrete infrastructure. And then in 2000... got fleshed out more during the George W. administration. They added a fee so people wouldn't abuse it. And then the biggest change the offer of compromise did occur in 2012. They changed the rules in a way that we'll expound upon later. So that's the offer of compromise as a government function, a thing where you can settle your debt with the IRS for less than what you owe if you meet certain criteria. As a marketing phenomenon, that's where I show my age. I've been in this industry since the offer and compromise kind of became a sales jingle on late night TV.
Mm-hmm.
Settle your debt with the IRS for less what you owe, which included lots and lots of scams and lost money, pennies on the dollar, burned up money, just a marketing phenomenon that started in Southern California and Florida. Lots of scams, lots of businesses shut down by attorney generals and the FTC. Just a lot of scams have come around the offer and compromise, unfortunately. But I myself was born in that culture, unfortunately. The culture of Washington Tax Services is a culture that has really, from the very beginning, had integrity as part of our principle. That's why we're still around 30 plus years. That's the marketing history and the actual history.
So maybe that brings me to another question where oftentimes you'll see people who are saying, or there's sort of, if you look online, don't get an offer and compromise, or be wary of an offer and compromise. Does that sort of stem from that history, or is there more to it?
Yeah, it is kind of a marketing kind of contrarian take. People are, it's like, instead of filling people with magical thinking about offer and compromises, how about fill them with skepticism? So they use the part of their brain to say, oh, maybe I don't qualify, or maybe I don't qualify, but actually do, It's just kind of a marketing contrarian take.
So when somebody comes to Washington Tax and says, hey, I'm looking for an offer and compromise, I've got a liability, where do you take somebody with that thought? Do you take them down the road of, yeah, let's go that way, or do you give them other options as far as these, it might not be something you can do, something we could do for you, but there might be another possibility for settlement of that liability?
We don't sell offer and compromises. That's not our MO. We sell representation, of which an offer and compromise could be an avenue of relief. But sometimes people will call and see if I qualify, and we'll do a rigorous interview or deep dig analysis, see if you qualify, then you can pay us once we greenlight it.
Yeah, I mean, it seems as if it's something that is out there as the only option. Sometimes people think that is for them to settle something, or it's the thing they've heard the most. Mm-hmm. And there's almost sort of an education piece, and maybe that's why we're doing this podcast, where you're no, that's something that isn't going to be, in this case, doable.
Well, skepticism towards the offer in compromise is well-founded because we've done the data on our clients, and the IRS has reported numbers. Now, of course, we only do offer in compromise for people that qualify. I know some companies that don't. Unfortunately, they're very few and far between because there's a lot less scams in this business than there once was.
But there's still a lot of people who try for an offer who get denied that, and that's what we at Washington Tax will do the legwork to figure out if you would qualify before even applying, right?
Yeah. Filing an offer in compromise when you don't qualify is a mistake.
Right.
Why? It worsens your situation.
How?
Because the offer in compromise freezes your collection statute expiration dates for the duration of the offer plus a 1-month penalty. So if you have a debt that's expiring, don't file an offer. We've seen people get bad professional advice to do offers. And so sometimes doing an offer is a bad idea. Back to what I was saying, I think of our clients who owe the IRS, 28% of our clients get offers. So knowing that, it's never like, okay, it's always our plan A, but we have plan B, C, D, which includes penalty waiver, livable installment agreements, currently not collectible where the case is closed, waiting for time to expire and the statute of limitations clock in. And occasionally, we tell people to do nothing. I will be honest. If we see that nothing has to be considered an option, wait for the IRS to hit you and just let the clocks tick on your statute of limitation.
Interesting. Yeah. So, do we want to give an example of...
Let's look at two. There's the most common offer in compromise is a doubt as to collectability, where you basically are giving a financial statement showing that you can't pay your tax liability back before the debt expires. Mm-hmm. And that includes your income, your disposable income won't pay it back until it expires, and your liquidable assets won't pay it off, and your regular assets that aren't so liquidable, like a house. So the doubt as a collectability offer is the most normal kind of offer where you prove that you can't pay back your liability before it expires. What are the important data inputs for that? The last year that your debts are going to expire. So not your oldest year, your most recent year, like say 2021. If you owe in 2021, that debt's going to expire in 2032.
10 years.
And so May of 2032 is what the number you're going to work with. What's the second data input? Your disposable income after all your necessary living expenses are paid. And then the third is your asset picture. Houses are valued at 80%. Some other assets are discounted, like IRAs and 401ks for the taxes you have to pay and the brokerage fees. But anyway, DAS collectability offer is great, but you're going to have to prove you can't collect. One important thing about DAS collectability offers are your financial condition changes. So offer and compromise, DAS collectability are based on what your situation is now. Next year, things could change. And 2 years from now. Mm-hmm. In fact, we have many customers who have done offer and compromise successfully in our career, and a couple years later, they're multimillionaires. Mm-hmm. Seen it a few times. So, that is the beauty of an OIC. Your current situation may suck, and that's the silver lining of your crappy situation, your inability to pay. So that's DAS collectability.
And then you said the second. What is the second? How does
the
that
second
vary?
is, and this is a unique one, but sometimes it is applicable, and that is an offer and compromise ETA, or effective tax administration. And that's for people that will show on paper they can pay their debt, and they call that reasonable collection potential. If you could pay the debt, that's mandatory for an OIC ETA. But there's two reasons you're going to apply for an offer. One, you may show the financial ability to pay the debt, but you're not able to access your equity, for example. Say you're an old person that's trapped in this house. It's got equity, but you're not able to pull it out. That's the classic ETA situation, right? Mm-hmm. The second one is more interesting, and that is there is some unusual policy which created your tax liability that's kind of unfair, and you're kind of pleading to the IRS for some forgiveness of the debt.
Like, what could be an example of that?
That's a very good question, and this case, I'm going to give you information about a case that we're trying right now. The IRS, if you sell stocks, and you sell them rapidly, almost impulsively, like a gambler or a day trader.
Sure.
If you're not a mark-to-market election stock seller, you are disallowed wash sales for stocks that you buy and sell quickly. And that can really result in a heavy tax liability because you're not allowed the wash sale. Now, if you're a mark-to-market election person that applies to be a mark-to-market election person, makes the election, you get your wash sales. There's no disallowing. But I do have an OIC ETA. Guy has a high net worth. The net worth is hard to access due to his family's being in Silicon Valley. Hard to sell their house. Kids all in schools. Hard to come up with the full $2.5 million that he owes. But I am doing an OIC ETA for a policy reason. And that is, wash sale rules cost him $1 million extra in taxes. So we're asking the IRS to entertain nearly a $1.5 million offer at 2.5. That is like gambling with the IRS. I mean, you're freezing. He knows he's freezing his statute for 6, 7, 8, 9 months plus the 1 month penalty, but it's worth the risk to him. By the way, everyone listening, filing an offer in compromise does have one benefit, it for sure, even a bad one. It does stop the collection process. I would never recommend somebody do it just for that purpose.
So, just maybe an obvious question, but looking at it from the IRS's side, what's in it for them? I mean, why is, kind of goes back to the history of it, is why do they want less than what is owed?
I think for an elderly person that can't that would be homeless if they sold their house, they say there's enough equity in the house to pay it, and it would be a real financial hardship to have this old person sell their house. Mm-hmm. That ETA, I mean, the IRS is, at this time, set up to be fair. And that is fair. Now, this wash sale wealthy guy in California, we felt that somebody might listen. Paying 1.5. And so we're also, I should add to everybody listening, you can do an offer in compromise in 24 monthly payments in 2 years. Which is an aggressive way to pay an offer. Most offers, however, are reviewed. You pay 20% down and then approved in 6 months, and then you pay them in roughly months 9 through 12, the remaining 80%. Mm-hmm. But there are 24-month payment offers. Mm-hmm. The OIC ETA that I just explained is a 24-month payment. So the IRS will get an accelerated amount of what they owe. I think that'll be a factor too. Maybe in another podcast we can tell you whether the OIC ETA worked or not. Yeah,
we'll follow up.
Yeah.
In Washington Tax, we've been looking at offering compromise for our clients for a long time. What have you seen, in the last couple of years? Is there any trends, anything that you're seeing recently that's different, or that's something that someone might pay attention to now that they didn't have to in the past?
It's an amazing that it's been 10 years. But the 2012 law change, which we have YouTube videos on, it was big and historic. And so OICs were, I almost forget what they were before, mm-hmm. but basically finding the collection statute expiration date of the last year that you owe is really your first thing. So if you owe 100, let's do a case. We'll make sure the numbers are easy to divide on the fly here. 100,000 owed. Debt's going to expire in, we'll say, in even 10 years, right? Okay.
Very easy.
120 months. Yeah. Or no, in 100 months. Not 120 months, 10 years. So what's that? Almost 8 years. So if you have a debt that's 100,000 that's going to expire in 100 months, 100,000 divided by 100 months is 1,000. If your disposable income is higher than 1,000 a month after all your necessary living expenses, not a payment on your speedboat. If your disposable income is over 1,000, you're not getting an offer. Period. Maybe you get an OIC ETA, but you're not getting an offer. So what's happened the last 10 years is we look at cases, you want to talk about an offer? What's your last CSED? Collection statute expiration date. And right. That's where we start. Now, here's some other little advice that, hey, any other tax professionals maybe listen to this podcast. One of the beauties, considering how important that last CSED is we recommend to clients to go on directpay.irs.gov and knock out their recent balances to make the OIC math better.
Mm-hmm.
So say you owe 7 years from 2007 to 2020. We're telling people, pay off 20 because the math gets better.
I see.
That last CSED is everything.
Right.
Not many people advise their clients like that. And with the IRS being not this overpowering collection agency like they were between 1910 and 2005, 2016 maybe. They're not super aggressive all the time. Now you can go and better your OIC math by paying off the recent liabilities, which also leads to our advice to all our clients, because we always want to think maybe a client's going to qualify for an OIC someday. Always file and pay your current taxes. You don't want to make a new CSED that's going to make the OIC calculus back worse. That is the paradigm shift of the 2012 law as we look at it through those lenses.
Yeah, I think that's some really useful information for people. Is there anything else we want to kind of touch base on, or what do you think?
Don't file it. If you're let's now promote our own self-interest.
Sure.
Okay, if you're genuinely really high on doing an OIC, contact us through the website watax.com. We can maybe do a preliminary analysis on the phone at no charge. Or if you really want us to do a deep dig, maybe we charge a few $100 to $1,000, something like that, to do an OIC analysis to see if you qualify. Don't do it unless you've talked to a reputable tax relief firm or a tax attorney, CPA, or enrolled agent that really does this stuff. As we said, don't do an OIC haphazardly, or it will have a negative effect.
Well, I mean, and maybe that's a good place to leave it. It almost kind of comes back around to one of your earlier points: is we don't sell OIC as the end goal of a resolution, but we offer a resolution as the end goal for the client. Mm-hmm. One of the options is possibly OIC, but there are other things that you could qualify for.
A reasonable cause penalty waiver, a first-time abatement.
Yeah.
We like to do what works. We don't like to do magical thinking and just kind of experiment, except occasionally, like the OIC ETA I described earlier today.
Make sure, if you're doing your research, that the company you're going with, Washington Tax being one of the foremost ones to do so, isn't solely offering this one option, which is not always and often is not the correct fit for many. Cool.
Thank you, Stuart.
Yeah, thanks, Jay.
All right.
Good talk.
Yep.
All right. Bye.